They made a confession. It was buried in a 347-page document. It was written in language so dense, so deliberately confusing, that they knew you would never read it. They were counting on your ignorance. They were banking on your apathy. They assumed you would scroll past. They assumed you would trust the experts. They assumed wrong, because I read it, every single page, every footnote, every technical definition. And what I found will change everything you thought you knew about silver, about the banks, about the game they have been playing for decades. The document is called Basel III. It is the global rulebook for banking. It was written by the Bank for International Settlements. That is the central bank of central banks. The shadow institution that sits above the Federal Reserve, above the European Central Bank, above every monetary authority on the planet. And hidden in this document is a loophole, a classification, a single decision that they prayed you would never discover. They classified gold as a Tier 1 asset. They gave it zero risk weight. They told the banks that gold is as safe as cash, as safe as U.S. Treasury bonds. This was a revolution. For the first time in modern history, gold was officially recognized as money. But here is what they did not tell you. Here is the secret they buried on page 247. They did not give silver the same treatment. Silver was classified as a Tier 3 asset. It was given an 85% required stable funding ratio. In plain English, this means the banks must hold 85 cents of capital for every dollar of silver exposure. Gold requires 0. Silver requires 85%. This is not an accident. This is not an oversight. This is a deliberate, calculated decision to suppress the one metal that threatens their entire system. And now, that decision is about to backfire in spectacular fashion. You see, the Basel III rules are not optional. They are mandatory. Every major bank in the world must comply. The deadline has passed. The implementation is complete. The consequences are only beginning to surface. For decades, the banks have been running a paper silver operation. They have been selling silver they do not own. They have been creating paper contracts that exceed the physical supply by a ratio of 300 to 1. They have been using this paper to suppress the price, to keep silver cheap, to keep you from realizing what silver truly is. But Basel III changed the economics. Under the old rules, holding paper silver was free. The banks could short the market all day without any capital cost. It was a license to manipulate, a free pass to fraud. Under the new rules, every paper silver position requires capital backing. Real money, sitting in reserve, doing nothing, earning nothing. For a bank like JP Morgan, this is catastrophic. They hold billions in silver derivatives. Under Basel III, they must set aside hundreds of millions in capital just to maintain those positions. So what are they doing? They are unwinding. They are closing. They are getting out. And when the biggest short sellers in history start buying back their positions, what do you think happens to the price? It goes up. It goes straight up. This is the loophole. Not for them, for you. They created Basel III to protect themselves, to reduce risk in the banking system, to prevent another 2008. But in doing so, they accidentally lit the fuse on the silver market. They made paper silver expensive. They made physical silver mandatory. They created a scenario where the only way to hold silver without capital penalty is to hold the real thing. And the real thing is running out. In this deep dive investigation, we are going to expose the Basel III silver loophole. We are going to explain exactly how the 85% RSF rule is forcing the banks out of the paper market. We are going to show you the evidence, the vault drains, the Shanghai premiums, the delivery failures. We are going to name the institutions that are accumulating physical silver while telling you to sell yours. And we are going to reveal the timeline. When does the squeeze become visible? When do the headlines catch up to reality? When does silver break $100? The banks made a confession in Basel III. They admitted that gold is money, but they also admitted something else, something they hoped you would miss. They admitted that they cannot control silver anymore. The cost is too high, the capital requirements are too steep, the physical supply is too thin. They built a system designed to suppress silver forever, but that system just became unprofitable, and when the banks stop manipulating, the market finds true price discovery. It finds the price where supply meets demand. It finds a price that reflects the industrial shortage, the monetary premium, the decades of suppression. That price is not $30. It is not $50. It is not even $75. That price is triple digits, minimum. They want your silver. They need your silver. But thanks to Basel III, they can no longer afford to short it. The trap is reversed. The hunters have become the hunted. In the next section, we are going to break down exactly what Basel III is. We are going to explain the tier system. We are going to show you why gold got special treatment and why silver was deliberately excluded. We are going to follow the money and expose the institutions that wrote these rules. The confession is on paper, the evidence is in the vaults, and the clock is ticking. Welcome to the greatest wealth transfer of the century. Let us start with the basics. What is Basel III and why should you care? Basel III is a set of international banking regulations. It was created after the 2008 financial crisis, the crisis that was caused by banks taking too much risk with too little capital, the crisis that required trillions in bailouts, the crisis that they promised would never happen again. The Basel Committee is based in Switzerland. It is housed in the Bank for International Settlements. This is the most powerful financial institution you have never heard of. It sets the rules that all other banks must follow. Basel I came in 1988. Basel II came in 2004. Basel III was finalized in 2017 and fully implemented by 2023. Each version increased the capital requirements. Each version tried to make the banking system safer, but here's the key. Basel III did something unprecedented. It reclassified physical gold. Before Basel III, gold was considered a Tier 3 asset. It was treated like any other commodity. It was given a 50% risk weight. Banks had to hold capital against it. After Basel III, physical allocated gold became a Tier 1 asset, 0 risk weight. This means banks can hold gold and count it as if it were cash, as if it were U.S. Treasury bonds, as if it were the safest asset on Earth. This was not an accident. This was a deliberate policy decision by the central banks. Think about what this means. For the first time since 1971, since Nixon closed the gold window, the global banking system officially recognized gold as money, not a commodity, not a barbarous relic, money. The smart analysts immediately asked the obvious question. If gold is Tier 1, what about silver? The answer was silence. Then it was obfuscation. Then it was the truth buried on page 2147. Silver was not reclassified. Silver remains a Tier 3 asset. Silver carries an 85% required stable funding ratio. This is the highest penalty category for any commodity. Let me explain what the RSF means. Required stable funding is a liquidity metric. It measures how much long-term funding a bank needs to support its assets. The higher the RSF, the more expensive the asset is to hold. Cash has 0% RSF. Gold now has a 0% RSF. Government bonds have low RSF. Silver has 85%. Corporate junk bonds have lower RSF than silver. Subprime mortgages have lower RSF than silver. The regulators looked at the entire universe of assets and decided that silver is one of the riskiest things a bank can hold. Does that make sense to you? Silver, a physical metal that has been money for 5,000 years. A metal that is essential for solar panels, electronics, and medical equipment. A metal that is consumed and disappears forever. They classified it as riskier than derivatives, riskier than credit default swaps, riskier than the very instruments that caused 2008. This was not a mistake. This was a choice. And the reason for that choice is simple. They needed to keep silver suppressed. They needed to make it expensive for banks to hold silver. They needed to prevent silver from following gold into the monetary system. Because if silver becomes money, the game is over. You see, gold is expensive. An ounce costs over $2,000. The average person cannot accumulate much. But silver? Silver is the people's money. Silver is affordable. Silver is accessible. Silver is the metal that threatens their control. So they rigged the rules. They made gold cheap to hold and silver expensive. They incentivized banks to hoard gold and dump silver. They created a two-tier monetary system where only the elite metal gets protection. But here is where they miscalculated. The 85% RSF does not just make silver expensive to hold. It makes paper silver expensive to trade. Before Basel III, banks could sell unlimited paper silver contracts. They could naked short the market into oblivion. There was no cost, there was no penalty, there was no limit. After Basel III, every paper silver position requires capital backing. A bank that sells $1 billion in paper silver must set aside $850 million in stable funding. That money is locked up. It earns nothing. It is a pure cost. For JP Morgan, which holds an estimated $20 billion in silver derivative exposure, the capital cost is astronomical. We are talking about $17 billion in required funding, just to maintain their short position. No profit margin can justify that cost. No manipulation scheme can survive those economics. So the banks have a choice. Keep the positions and bleed capital, or close the positions and let the price rise. They are choosing to close. The evidence is everywhere. COMEX inventory is at record lows. Bank of America covered millions of ounces. The commercials have reduced their short positions by 40% in the last year. Basel III did not just change the rules. It changed the economics of manipulation. It made fraud unprofitable. In the next section, we are going to explore the specific loophole. We are going to show you exactly how physical silver holders benefit while paper silver collapses. We are going to follow the metal from the COMEX vaults to Shanghai. And we are going to reveal why the banks are now on the same side as you. The Basel III trap was set for you, but the banks walked into it themselves. Now we arrive at the heart of the matter, the loophole that changes everything. Under Basel III, there is only one way to hold silver without the 85% RSF penalty. You must hold it physically. You must hold it in allocated form. You must hold it outside the banking system. Read that again. If a bank holds paper silver, it pays 85%. If a bank holds unallocated silver, it pays 85%. If a bank holds silver derivatives, it pays 85%. But if you hold physical silver in your own possession, you pay nothing. There is no RSF. There is no capital requirement. There is no penalty. The regulators created a rule that punishes banks for holding paper and rewards individuals for holding physical. They did not intend this. They were trying to reduce bank risk. They were trying to force banks out of speculative commodity positions. But in doing so, they accidentally created the greatest incentive in history to own real silver. Let me explain how this loophole works in practice. Imagine you're a hedge fund. You want exposure to silver. Before Basel III, you would buy paper silver. You would buy a futures contract on the COMEX. You would open a position with a bullion bank. Easy, cheap, liquid. After Basel III, that same position carries a capital cost. Your prime broker has to set aside 85 cents for every dollar of exposure. They pass that cost to you, your financing rate goes up, your margin requirements increase, your returns get crushed. But there is an alternative. You can buy physical silver, you can take delivery, you can store it in a private vault outside the banking system. When you do this, you remove the silver from the fractional reserve system. You eliminate the paper claims, you own the real thing. And here's the key. Private ownership has no RSF. The 85% rule only applies to bank balance sheets. If the silver is in your vault, in your name, it is invisible to Basel III. This is why we are seeing unprecedented demand for physical silver. This is why the Perth Mint has waiting lists. This is why dealers are charging record premiums. This is why China is draining the Western vaults. The smart money understands the loophole. They know that paper silver is dying. They know that physical silver is the only silver that counts. Let us look at the evidence. COMEX registered inventory has collapsed from 150 million ounces to under 30 million. This is a decline of 80% in 3 years. The metal is leaving the exchange system. Where is it going? Into private vaults, into industrial supply chains, into the hands of people who understand what Basel III means. The Shanghai premium is another proof. Silver in China trades $3 to $5 higher than silver in New York. This premium exists because China is buying physical. They are paying extra to get real metal instead of paper promises. The arbitrage should close this gap. If silver is cheaper in New York, traders should buy it there and sell it in Shanghai. But the arbitrage is failing. The metal is not available. The paper price in New York is fiction. The physical price in Shanghai is reality. Basel III accelerated this disconnect. By making paper silver expensive for banks, it reduced the liquidity of the paper market. There are fewer sellers. There are fewer contracts. The paper market is shrinking while the physical market is exploding. This is the loophole in action. Physical silver is decoupling from paper silver. And when the decoupling is complete, the paper price will be exposed as meaningless. The true price of silver is not set by the COMEX. It is set by what buyers will pay for real metal. That price is already $30 to $40 higher than spot if you try to buy coins. That price is $3 to $5 higher in Shanghai. That price is infinite if you need silver for a factory and cannot find supply. The banks wrote the Basel III rules to protect themselves, but they forgot about you. They forgot that individuals can hold silver without penalty. They forgot that physical demand cannot be controlled. They created a rule that kills paper silver and crowns physical silver. And you are holding physical silver. You are on the right side of the loophole. In the next section, we are going to look at the paper-silver collapse in detail. We are going to show you the specific mechanics of how the COMEX is failing. We are going to name the banks that are covering, and we are going to reveal the timeline for when paper-silver becomes worthless. The loophole is open. The smart money is walking through. The only question is whether you will join them before the door closes. The paper-silver market is a crime scene, and Basel III just turned on the lights. For 50 years, the banks have operated a fractional reserve system for silver. They sell paper claims that exceed the physical supply by a ratio of 100 to 1, sometimes 300 to 1, sometimes more. This is not speculation. This is documented fact. The BIS publishes the data. The LBMA publishes the data. The COMEX publishes the data. They admit to selling more silver than exists. How does this work? Imagine you deposit 1 ounce of silver at a bank. The bank takes your ounce and stores it in a vault. Then they sell paper claims against that ounce. 10 claims, 100 claims. Each claim says the holder owns 1 ounce of silver, but there is only 1 ounce. If everyone demands delivery at once, 99 people get nothing. This is the paper-silver market. This is the system that has suppressed the price for decades. This is the fraud that Basel III is destroying. Under the old rules, the banks had no cost for running this scheme. They could sell unlimited paper. They could naked short without penalty. They could create infinite supply out of thin air. Under Basel III, every paper position carries capital cost. The 85% RSF means banks must hold real money against their fake silver. The economics have flipped. Fraud is no longer free. Manipulation is no longer profitable. So what are the banks doing? They are closing positions. They are covering shorts. They are reducing exposure. The Commitment of Traders report shows this clearly. The commercial short position, which is dominated by the bullion banks, has declined by over 40% in the last 18 months. The banks that were aggressively shorting silver are now reducing their bets. JP Morgan is the largest player. For decades, they have been accused of manipulating the silver market. They have paid $920 million in fines for spoofing. They have been investigated by the DOJ. They have been sued by investors. And now they are covering. Their trader positions show a dramatic reduction in short exposure. They are buying back the paper they sold. They are closing the loop. But here is the problem. When you cover a short, you need a seller. When JP Morgan wants to buy back 100 million ounces of paper silver, someone has to sell it to them. Who is selling? The weak hands, the retail traders who panic during dips, the speculators who get stopped out, the algorithms that follow momentum, but the weak hands are running out. The paper silver market is thinning. The open interest on COMEX is declining. There are fewer contracts outstanding. Less liquidity, less supply of paper to buy. This creates a feedback loop. As the banks cover, the price rises. As the price rises, more shorts feel pain. As shorts feel pain, they cover. The loop accelerates. We saw this in 2021 during the Wall Street bet squeeze. We saw this in 2024 during the industrial panic. We are seeing it now in the slow grind higher. But Basel III adds a structural element. This is not just a short squeeze. This is a regulatory mandate to exit. The banks are not covering because they changed their view. They are covering because the rules changed. And when the rules force you to buy, you buy at any price. Let us look at what happens when paper silver fails completely. The COMEX operates on trust. Traders buy contracts expecting to either sell them before expiration or take delivery. Most contracts are settled in cash. Only a tiny fraction demand physical metal. But what if that changes? What if more traders demand delivery? What if the eligible inventory is not really available? What if the claims exceed the metal? This is called a delivery failure. It means the exchange cannot fulfill its contracts. It means the paper price becomes meaningless. It means true price discovery begins. We are already seeing stress in the system. Delivery times have extended. Premiums have widened. Some contracts are being settled with cash plus premium because the metal is not available. Basel III accelerates this stress. By making paper expensive and physical cheap, it incentivizes delivery. Why hold a paper contract with capital cost when you can take physical metal with zero cost? The trickle of deliveries is becoming a flood. The registered inventory is disappearing. The vaults are draining. When the last ounce leaves the COMEX, the paper market dies. And the only price that matters is the price of real metal. That price will be determined by industrial buyers who need silver for solar panels, by governments who need silver for reserves, by individuals who understood the loophole and bought early. That price will not be 30. It will not be 50. It will be whatever it takes to shake the metal loose from strong hands. In the next section, we are going to look at who benefits from this collapse. We are going to follow the metal from west to east. We are going to name the institutions that are accumulating. And we are going to show you why you are positioned perfectly for what comes next. The paper is burning. The physical is shining. The collapse is underway. Every market crash is a wealth transfer. The only question is which direction the wealth flows. In 2008, wealth flowed from homeowners to banks. In 2020, wealth flowed from small businesses to big tech. In the dot-com crash, wealth flowed from retail investors to insiders who sold early. The Basel III silver event is another transfer. But this time, the direction is reversed. Wealth is flowing from the banks to the physical holders, from the paper speculators to the industrial accumulators, from the west to the east, from the manipulators to the prepared. Let us trace this transfer step by step. First, the banks. JP Morgan, HSBC, Bank of America, and the other bullion banks have held massive short positions in silver for decades. They made money by selling paper, suppressing the price, and buying back cheaper. But Basel III changed the equation. Now their short positions carry capital cost. Every month they hold, they bleed money. Every quarter, the regulators check their balance sheets. Every year, the cost compounds. So they are covering. They are buying back paper. They are taking losses. They are transferring their accumulated wealth to whoever sold them that paper. Who is selling? Initially, the weak hands, the retail traders who panicked. But the weak hands are exhausted. The remaining paper is held by strong hands, funds that understand the thesis, traders who will hold for delivery, institutions that see what is coming. The banks are paying premium to exit. They are transferring their wealth to the prepared. Second, the industrial buyers. China, South Korea, Japan, and the manufacturing nations of the world need physical silver. They need it for solar panels, electric vehicles, smartphones, and missiles. They need it for the green transition. They need it for industrial capacity. These buyers do not care about the COMEX price. They care about supply. They will pay whatever it takes to secure metal for their factories. And they are paying. The Shanghai Premium proves it. Chinese buyers are paying $3 to $5 more per ounce than the spot price. They are draining Western vaults. They are flying metal from New York to Hong Kong. They are transferring ownership from the financial system to the industrial system. This metal is not coming back. When Samsung uses silver in a smartphone, that silver is gone forever. When a solar panel is installed on a roof, that silver is locked up for 30 years. Industrial demand is permanent demand. It is consumption, not speculation. The banks are losing their metal to the factories of Asia. They are transferring their reserves to the supply chains of the future. Third, the sovereign buyers. Central banks are accumulating gold at record pace, but they are also quietly accumulating silver. Russia has been building silver reserves. China's state entities have been hoarding. Even Western governments are starting to stockpile strategic metals. These buyers operate in the shadows. They do not announce their purchases. They do not move markets with press releases. They accumulate slowly, quietly, relentlessly. And they are using the Basel III dislocation to buy cheap. When the banks smash the paper price, the sovereigns buy physical. They thank JP Morgan for the discount. They add to their vaults while the West sleeps. The wealth transfer is global. It is moving from the paper system to the physical system, from the financial centers to the industrial centers, from the old world to the new world. And where do you fit in this transfer? You are on the right side. You hold physical silver. You're not dependent on bank solvency. You're not exposed to paper failure. You own the real thing. When the paper market collapses, you will not be the victim. You will be the beneficiary. Your silver will be the silver that everyone wants. Your stack will be the stack that commands premium. The banks will beg you to sell. The dealers will offer you record prices. The industrial buyers will pay whatever it takes. And you will decide. You will choose whether to sell or hold. You will name your price. This is the power of physical ownership. This is the reward for understanding Basel III. This is the wealth transfer in your direction. But let me be clear about timing. The transfer is not instant. It is happening over months and years. There will be volatility. There will be smashes. There will be days when you doubt the thesis. Ignore the noise. Focus on the structure. Basel III is permanent. The capital costs are permanent. The incentive to exit paper is permanent. The transfer is unstoppable. It is just a question of speed. In the final section, we are going to give you the strategy. We are going to tell you exactly what to do with this information. We are going to provide the timeline, the targets, and the psychological armor you need to survive the volatility. The wealth is flowing. The question is whether you will catch it. You now understand what they never wanted you to know. You understand Basel III. You understand the 85% RSF penalty. You understand why paper silver is dying and physical silver is rising. But knowledge without action is worthless. So let us build your battle plan for the coming months and years. Step 1, confirm your physical position. If you do not already own physical silver, the time to buy is now. Not next week, not next month. Now. Buy from reputable dealers. Buy coins, bars, or rounds. Buy whatever you can afford. The premium is high, but the premium is also proof that physical silver is scarce. Do not buy paper silver. Do not buy ETFs. Do not buy unallocated accounts. These instruments are exactly what Basel III is killing. They carry counterparty risk. They carry capital cost. They will fail when the system breaks. Buy physical. Take delivery. Store it yourself. Step 2, understand the timeline. Basel III. Implementation is complete, but the effects take time to manifest. Banks are unwinding positions gradually. They are not dumping all at once. They are managing their exit. Expect the real fireworks in the next 12 to 24 months. This is when the COMEX inventory approaches zero. This is when delivery failures become public. This is when the paper price divorces from reality. In the meantime, use every dip to accumulate. When the banks smash the price for window dressing, thank them. Buy more. Stack deeper. Build your position while they subsidize your entry. Step 3. Ignore the volatility. There will be days when silver drops 5%. There will be weeks when it feels like the thesis is broken. There will be headlines screaming that silver is finished. Ignore all of it. The volatility is the paper market thrashing. It is the algorithms fighting. It is the banks desperately trying to shake you out. It has nothing to do with physical reality. Physical reality is simple. Supply is shrinking. Demand is growing. Basel III is forcing the banks out. The math is the math. When silver drops, check the dealer premiums. Are they falling? No, they are rising. This tells you the truth. The paper price is noise. The physical price is signal. Hold through the volatility. Do not sell to the banks. Do not give them your silver at discount prices. Make them pay full price or get nothing. Step 4. Know your targets. Based on the structural changes from Basel III, we can project price targets. And the first major target is $50. This is the 1980 and 2011 high. It is psychological resistance. When we break $50 with conviction, the world will notice. The second target is $75 to $80. This is where we are trading now. This is the new floor being established. Basel III has repriced silver from $20 to $75 in 3 years. The trend continues. The third target is $100. This is the century mark. This is where media attention explodes. This is where FOMO brings in the masses. The fourth target is $150 to $200. This is fair value based on the gold-silver ratio normalizing. If gold trades at $3,000 and the ratio falls to 15, silver hits $200. This is not fantasy. This is historical normal. Beyond $200, we enter price discovery. We enter a world where silver is repriced for the new economy. Solar demand, EV demand, AI demand, green transition demand. The price could go much higher. Step 5. Decide your exit strategy. Holding forever is not a strategy. You need to know when and why you will sell. My suggestion, do not sell for dollars, sell for assets. When silver hits $100, do not sell for cash. The cash is losing value. Inflation is permanent. You will just exchange one problem for another. Instead, sell for real estate, sell for farmland, sell for productive businesses, sell for assets that generate income and preserve wealth. Calculate how much silver you need to achieve your goal. If you want a house, figure out the silver to house ratio. When silver reaches the price where your stack buys the house, make the trade. This way, you're not gambling on price. You're exchanging one hard asset for another hard asset. You are using silver as the bridge from here to there. Step 6, prepare for the chaos. When the paper silver market fails, there will be chaos. The COMEX might suspend trading. The banks might default on contracts. The government might intervene. Do not panic. This chaos is the end game. It is the moment when physical holders are proven right. It is the moment when the transfer completes. If you hold physical silver in your possession, you are insulated from the chaos. Your silver is your silver. No exchange can freeze it. No bank can confiscate it. No government can click a button and make it disappear. This is why physical matters. This is why delivery matters. This is why the Basel III loophole rewards you specifically. Final thoughts. The banks wrote Basel III to protect themselves. They classified gold as money and silver as garbage. They thought they could control the transition. They thought they could manage the exit. They were wrong. By penalizing paper silver, they accelerated the physical squeeze. By making manipulation expensive, they ensured their own defeat. By rigging the rules, they created the loophole that destroys them. You are holding the winning hand. You have physical silver. You understand the game. You know the timeline. The banks want your silver, but they will have to pay the price you demand. And that price is going much, much higher. Welcome to the right side of history. Welcome to the Basel III loophole. Welcome to the year of silver. Hold strong. Stack deep. And never forget what they tried to hide. Subscribe for the next update. The story is just beginning.